Righto, money miners. Half the content in the episode today is because of MMS moving the dirt.
We got to have a big yarn about all things happening in Kalgoorlie processing facilities, and Black Cat have raised a bunch of money. Sandfire's put out a quarterly. I'm going to spin some shit about the Anglo coal sale investment process, and JD's going into diamonds.
Diamonds.
And Vault reported too.
Where we starting today, guys?
MMS, they're a diamond of a company. I can tell you that much. The diamond of open pits.
Go MMS.
Oh, right. Where we start? GC, bit of bloody...
Sandfire.
A company close to my heart. Glad they recovered after I left.
No, they're doing just fine. So no, they put their quarterly report out today. So this quarter they had group copper equivalent production of around sort of 38,000 tonnes. They reiterated guidance, and that production result was very much largely in line with expectations. So that was 27,000 tonnes of copper, 21,500 tonnes of zinc. So fairly similar to last quarter. We'll just flash up the chart. You can see what they've done this quarter sort of compared against other quarters' production and costs and things like that. So they did just shy of 24,000 ounces copper equivalent at Matsa, which is a slight increase on the previous quarter. They maintained their annualised processing rate there at 3.6 million tonnes per annum, and there was an improvement in copper and zinc recoveries, which saw that copper equivalent production go a little bit higher.
Why is Mateo down quarter on quarter? Just looking at that chart, Ali, I thought that was ramping up.
They did have a planned shutdown there.
Right.
Yeah, so there was a planned shutdown, and then they also had some slightly lower head grades for that quarter as well. So they did 14.3 thousand tonnes of copper equivalent at Mateo as well. And just at Matsa, they also received an environmental approval for a new tailings facility there. So construction of that is sort of scheduled to commence Q4 FY25.
So that's obviously driven by because they still said they maintained their annual processing rate, but the grade obviously smashed them there.
Yeah, that's right. So then cost performance was mixed. So Matsa was, a lot of these numbers I'm speaking here are US, so $1.88 per pound versus $1.54 last quarter. They sort of attribute that to sort of lower byproduct volumes and prices, but then sort of looking forward beyond that, sort of those treatment and refining charges component of costs is likely to decline in the sort of second half of the financial year as sort of benchmark rates reset with sort of what's happening in the market at the minute.
Does the cost there for copper and zinc mines work the same as gold and copper? Like the zinc gets taken off the cost as like an all-in sustaining cost?
Credit, yeah.
Is that so? Okay, yeah. So that's not the. It works the same as someone that's selling a copper con for a gold project.
I think so. Okay. It's sort of quite similar.
Let's run with that.
And then Mateo, a slight improvement of the previous quarter down to $1.42 a pound. But probably more importantly, the net debt has reduced again by, US $51 million down to US $345 million. That was, largely attributable to, operating cash flow from Mats of US 73 and Mateo US 65 mil, and they had group capex of US 55. So, they're continuing, quarter on quarter to sort of de-lever this balance sheet, and, they could be in, net cash pretty soon if they continue at this rate. This actually has to be one of our favourite waterfall charts. Look at this, just sort of explaining from the start to the end of the quarter, and then providing that extra bit of detail even on the capex components there. So, good work on the waterfall.
I like
chart
chucking
there.
the debt in. I like that.
Yeah, no, it's just you can see like where things are, from start to finish, rather than just an aggregated, net debt number or net cash number, whatever it might be.
Go Sandfire.
I
I told them to do that.
I do find it really interesting. Like look at the relative contributions of both Mateo and Matsa. Now, one of them they paid a lot of money for. The other one they did not pay very much money for at all.
It's like the Even Stevens episode on Seinfeld.
Yeah,
a bit of it.
I think Mateo's turned out to be a ripper acquisition. I think like Matsa's, in time, it requires the elevated copper price to sort of backfill what they actually paid for that.
Yeah, and and that's reflecting in the P&L as well. So they generated US 121 million of underlying group EBITDA for this quarter. So just for reference, FY24 group EBITDA was US 362. So there's about a third of that. Sandfire currently capped at about Aussie 4.8 billion. So adding on that net debt US 350 roughly is EV of about say 5.3 billion. If you were to, I know this is very back of the envelope maths, but if you annualise that Q1 EBITDA, it sort of is trading on an EV to FY25 EBITDA multiple of about 11 times. So it's still a little bit exy, but we'll get to it in a minute. But, what else has happened for Sandfire during sort of the past quarter? Not a whole heap. I mean, they updated the Matheo resource and reserve. They put out like a Portugal exploration update on this Alvalade joint venture. Apologies if I pronounced that completely wrong.
No, I reckon that's spot on. I like it.
But interestingly, they were added to the ASX 100 during the quarter. So that was effective from the 23rd of September. So they're up 15% since they've been added to the index. But they're up year to date, I think at least last time I looked, at least sort of 44, 45%, which it's far, outperformed its sort of other ASX-listed copper peers. Not that there's much anyway. But, yeah, no, that's pretty much the update on Sandfire.
You look at that trading multiple that you mentioned there, Ali, 11 times EBITDA. It's pretty full, right? That's pretty full. Like I imagine management is going to be pretty damn motivated to use their script while it's got a bit of full value in it as a result of going into the index, blah, blah, blah.
Especially before copper prices go up if they do.
Yeah.
So you got best of both sides there.
Yeah. So they'll be wanting to do a deal. I'm almost certain of that. The challenge is just exactly.
Where,
everyone wants to do a copper deal. So, but this is the time when creative deal doers can really have a big impact. You've got funding capability. You've got capital market support. Like the deal makers need to get creative and find out where they can maybe carve out even just like a minority interest in an established asset, things like that. That just the rest of the market might not really see as an option. Like do funky deals like that, and you'll get rewarded, especially with a script like this.
Would something in like the Kalgoorlie copper belt make the most sense? Like getting something else, because they've already got obviously Sandfire America. Like they're obviously spread over vast across the world at the moment, and like even coming back into Australia's like. That's 4 jurisdictions they're operating in, but it sounds like pure play copper companies have to.
Yeah. I think you don't want to be stretched across too many time zones, and I think I've even heard Brendan Harris speak words to that effect in a call before. But
that's right.
One sale process that's documented at the moment that's right in their backyard is those Portuguese assets, JD.
Nevas Quavo. Yeah, that's the one I've sort of got my eyes on. In Portugal, so in that Iberian pyrite belt there was sort of talk about MAC having a look at it, so we're not sort of breaking ground on that conversation. The asset's owned by the Lundin Mining Group, so I think that is one, they'll have run the ruler over in the past. No idea where they're kind of at with that, but yeah, Brendan Harris of all people will know the value of his company's script right now, so very keen to see the other opportunities they're kind of looking at.
Dumb question with probably smart answers coming. Are there any copper ETFs?
Yes.
I'm sure there would be.
Which ones?
What ticker for one of them is Wire, I think.
Do you think we will see more of them in the future if the thematic gets a bit of momentum behind it?
Probably. I think you see where you get the best multiples is if you're the pure play copper listed on the NYSE. That's why no one can get multiple like Freeport. It's just amazing. Southern Copper's sort of similar. There's others too.
The ETF on the ASX is ticker Y. It's one of those global X ones. AUM right now is 265 odd million Aussie dollars. But what you'd really want to see, to conversations we've had in the past, Maddie, is like a US one where a lot of US kind of money goes, and that attracts capital from all over. But I do agree with what Trav said, Freeport being one of those sort of standout examples. The pure plays have attracted a lot of capital in the past. The generalists, those big the big companies just pull in the money from the funds that look at the first name on the list when they turn to mining.
Yeah, interesting. It'd be interesting to see if we see that'll get a bit of bloody mongrel behind copper. Speaking of copper, but not copper for this mob, Anglo coal asset divestment. Ding, ding, ding for me on this one.
Yeah.
Not technically a shareholder, but I have exposure.
So there's been a bit of street talk conjecture about the sale process of Anglo's Queensland coal portfolio, which is anchored by the Moranbah and Grosvenor mines. Up front, I just want to mention we're going to talk about Anglo American and Yancoal, which Maddie and I are ding 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 respectively on that one. The crux of the article in the Fin is that the bidders in the sale process of these assets have very little information in relation to the status of Grosvenor, where a fire earlier in the year saw that operation kind of shut down. A bunch of capex is going to be required to remediate and get that back online. It's going to take a long time.
Couldn't be the worst bloody time for a fire.
Yeah,
at a coal mine in terms of when this happened in
During
the
a sale
BHP
process.
deal and like
super average timing. Yeah.
I'll
read this bit out here. It says sources said Anglo's data room contains reams of documents on Grosvenor's geology and how coal can be extracted. However, it's all theoretical, and Anglo has carefully sidestepped making any implicit legal guarantees to buyers, since it could be years away before the mine is again up and running. I think that revelation in itself, it's not the end of a sale process like this. Anglo's a pretty motivated seller given the circumstances. And I think the practicality of bidding in a sale process like this is it's a pretty simple solution. You just structure contingent consideration around the into your deal mix that you provide to Anglo. You'll have some contingent consideration in relation to the time it takes to get Grosvenor back online and what the ultimate budget is, and then you can have kind of a scale accordingly, and everyone wins in those circumstances, and you have alignment on the seller and the buyer as a result of that.
Similar to Woodlawn in a way in terms of first production is payment.
Yeah, well, that's a deferred consideration. I'm talking contingent. Like you tie it again
not
to
deferred.
Upon an outcome happening.
Could it be contingent on first production?
I mean, I would I'd have like a sliding scale and the variables on both the time it takes to get it back online, because that's a big impact on value to you, and also the amount it costs you to get it back online too. But I mean, bankers can structure stuff around like things like this all the time. It's not out of the wheelhouse just from a sale process, but. I think I want to talk about like the bidders that are in the mix here, because not all the bidders in the mix are made equal. The bidders remaining, according to Street Talk, are Yancoal, Peabody. I'm going to group the next three together because they're kind of all affiliated. M Resources, Stanmore, and Indonesia's Wijaja family. Probably saying that wrong. Then there's an Indian consortium led by Avidsys Group and, of course, Glencore. So when I group some of them together, there's basically like 5 independent bidders left, right? The most motivated to pay top dollar, I agree with Street Talk, is Yancoal. They've got a whopping $2 billion in cash, no debt. They've signalled that they want to bid on these assets, and the parent company of Yancoal is supportive of that. They even turned off their dividend to be able to bid as much as possible in this sale process. But there's just one catch. FIRB approval.
Bingo.
Recently, like we've seen FIRB just drag their feet with approvals on minerals projects that are signposted to be sold to majority kind of Chinese entities. And what FIRB has done in these situations is they simply keep extending by a month. They extend by another month. They extend by another month. They don't definitively say we don't approve, but it's just the death by 1,000 cuts off extending another month. It's in effect what they've done in the past when there's stalemate, and it looks like they've done that again in relation to CZR Resources. It's been 10 months now and no determination from FIRB yet, although other deals get FIRB determination pretty quickly when there's no Chinese entities involved. And I think it's that timing uncertainty which kills deals. And personally, I think it'd be a pretty brave thing for an advisor to do to recommend Anglo actually engage with Yancoal as the preferred bidder in a sale process without having certain clarity on how FIRB will determine the acquisition and how long it will actually take FIRB to make that determination. So absent that certainty, I think for now we've got to put a line through Yancoal and look at the rest of the field there.
Can you get any clarity on FIRB prior to going with Yancoal?
I don't know. I think you engage with FIRB early and you can get some kind of in principle guidance, but I think the reality of it, I'm not an expert, but I think the reality of it is you don't actually get any determination and it's all subject to change and blah, 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 blah. So, as a result, I just kind of think, unless you had certainty on what FIRB would do, you can't advise that, this should be your preferred bidder, even if they're willing to pay $1 billion more than the next bidder.
Yeah. So I've heard that on the street a bit. That is the
obstacle.
That is the thing with Yancoal after it got hammered. It has recovered a bit since then, but it's like that overhang and because the cash hasn't gone anywhere.
Cash hasn't gone. No. There's other assets for sale, like you got Olive Downs, which is like they could bid on as well, but like for all intents and purposes, Kestrel now too, by the way. Then I want to talk about Glencore, right? They stand out in the rest of the field because I do hear that they're pretty motivated to pick up these mines, but they'll be disciplined on price. They are Glencore after all. They're going to be pretty sensible. Word on the decline is that they won't pay any more than $3 billion for the mines, given Glencore's own trading multiple isn't sort of reflecting their intrinsic valuation. So they or their shareholders believe that it might be more accretive for them to simply just buy back their own stock instead of actually spending $3 billion getting these new mines at what would otherwise be a higher multiple if they paid more.
Because they're sort of nearly back to the stage. They're trading a bit above before when like Tribeca went activist on them. Like they had a bit of a rip after that, but they're back down at $4 now.
Yeah. And met coal prices have come down. They've geared up the balance sheet to acquire Elk Valley, which in time I think will be a ripping acquisition, that one. The rest of the field I don't really have a ton of insight on, other than to say the acquisition price is a pretty big bite size relative to the market caps of those other kind of listed entities in the field. So funding an acquisition is going to be a tough task without a lot of debt or using Anglo's balance sheet or bringing in a partner into the mix to sort of have some sort of consortium funding. All of those are possible outcomes, by the way. But I think for now there's one more thing in this AFR article I wanted to bring up. Firstly, the opening sentence in the article is it's 2 weeks until Anglo American collects binding offers for its Queensland coal assets. And then the second last paragraph says, the auction was a direct result of BHP's unsuccessful hostile takeover approaches earlier this year. Of note, British takeover laws permit the big Australian to hit back with a fresh bid at the end of November. So just contemplate this for a moment. Final bids for this sale process are due in 2 weeks, and BHP is allowed to bid for Anglo again in 4 weeks. Combine that with the FT's big scoop 2 weeks ago that Mike Henry and his chief development officer were spotted in South Africa and even met with Anglo's second largest shareholder, the South African state-owned manager, PIC. As you can see here, call me stupid, but if I was running Anglo and I wanted to be as sensible as possible in value creation or optimization, are you really in a rush to wrap up the sale process on the Queensland coal assets before BHP is statutorily allowed to bid again for the entire company, given the fact that they appear to be, getting ready to make another bid? It looks like that's what they're doing by going to South Africa to me. Remember, BHP wanted Anglo to keep the coal assets where, they have pretty attractive synergies. BHP, they've got a bunch of rail and port infrastructure, and they can, certainly kind of achieve some very real synergies via acquiring Anglo's Queensland coal assets. However, BHP, at every opportunity, has told the market they're not participating in the sale process. They're not going to bid for these coal assets, and they're not named as sort of, still being in the data room or anything like that. But what if the sale process drags out for a few extra weeks to the point where BHP is allowed to bid for Anglo again? So that's November 29th. Then do you really sell those coal assets to any of those parties in the list if you get an NBIO from BHP on November 29th or November 30th, and it's a fair value, and one of the conditions is you keep the coal because they're going to get synergies from it?
Are they trying to do this for whatever reason, to get BHP away?
I think there's a lot of what Anglo's strategy has actually been all of the things that BHP wanted them to do other than sell the coal. So they are divesting the platinum. They're looking for a strategic option for the diamonds. They halted capex on Woodsmith, which Like all of the other parts, all the other things that, Anglo is doing is kind of in line with the things that BHP wanted them to do conditionally on getting a deal over the line. I just think I think BHP is going to pay more for Anglo if those coal assets are still in the portfolio versus divested. I don't think you're maximising value if your ultimate end game is selling to BHP by divesting them, after a fire at Grosvenor. Like, I just think you keep them and BHP will pay more.
But how much weight are you putting towards the coal assets for BHP in contrast to the copper of Anglo?
It's 100% like secondary. It's about those big juicy long life coal assets, copper assets. But don't discount the phenomenal cash flow generation that is these unbelievable coal mines as well. And BHP is a funny one because everyone talks about BHP wants more copper in its portfolio, blah blah blah. The iron ore and the met coal are going to be cash printers for a long time.
Yeah.
So. I guess taking it a step back, how strongly do you feel, or rather how likely do you think it is that BHP will on the 29th or 30th of November make another crack at Anglo, but at a level that does see that better value sort of attributed to the coal versus it being divested to sort of someone else?
I'm not sure. I think if you read the FT article, they try and suggest that sources close to BHP say that BHP won't actually make another move until Anglo has further simplified its portfolio, so maybe divested its platinum business. BHP took issue with Kumba as well, which is the iron ore business there too. So there are parts that are attracted to BHP, parts that aren't based on what Anglo's doing, but it looks like they're coming back. You don't fly to South Africa with your chief development officer, meet with government officials and the state money manager, unless you're pretty motivated to find a sensible path forward and do it the right way this time.
But wouldn't they? They could literally put forward all the same previous conditions just on a better ratio, couldn't they? For an improved bid.
Yeah, and I think it's there's a combination of both things because they're going to have to convince Anglo shareholders as well, and part of that's definitely value. The other thing too is Anglo shareholders might get pretty disgruntled with the lack of value uplift from a share price perspective since their kind of gold alone strategy. And it's for Duncan, we've given you 6 months. How long do we have to give you before you create some value here? We're net down since before BHP bid leaked. What's going on? Copper price is up.
Yeah.
So I sort of agree with most of what you said there, Trav. I think it all kind of makes sense. The one thing I'll just sort of add as kind of info for money miners is Anglo they're down 10% on, looking back the last 6 months, now capped at US 33 billion. Remember that it includes everything, the stakes and the other businesses and all. 33 billion pounds. So that is 65 billion Aussie. And if you're taking the US 3 billion value of the coal assets, 4.5 billion, sort of puts into context the stake of what the market's valuing that at, I guess, post the Grosvenor fire and whatnot. But just interesting to kind of think about.
Yeah, it's I'd assume Australia's coal expert for this sale process, Adam Batista's been consulted so far regarding this sales process. Is there anything about CRE insurance being engaged?
I'd assume so. I think it's quite a sensible thing to do. I mean, I imagine any potential bidder in this sale process is going to want to ensure that they have adequate coverage for business interruption on any of these mines because we've already seen how bad things can be when there is business interruption at Grosvenor.
Yeah, and and that probably goes to the point, why Adam loves coal insurance so much, broking those policies.
It's a big coal man.
Fucking hard work.
He goes for runs with a coal hat.
He loves it. He loves it. They CRE operate like a Millennium or a Citadel in a way. They're in pods.
Yeah.
Adam's your coal pod. Dave Harrison's your bloody construction engineer and manufacturer and probably renewables. That's his pod.
Yeah.
Steve Tarr.
Hard work pod.
Australian, African,
Africa.
Rest of the world. Hard rock mining insurance pod.
Yeah.
Mate.
Yeah.
CRE is the first 3 letters in creative, credible, and cremate, because that's what they do to the insurance competition. They cremate them. They're that good.
With a coal firepower.
Go
With the coal fire.
Go CRE.
Well done.
Oh, right, Ali GC, Black Cat.
Yeah.
BC8 raised a good chunk of dosh, $80 at 52 cents. And considering what they were trading at pre-gold being awesome, she's a bloody good chunky raise at a pretty good price.
Yeah, no, like you said, Maddie, huge raise, $80 million, 52 cents. So why have they, raised all this money for? So I'll just flash up the sources and use of funds here. So in a nutshell, they want to accelerate the construction, acquisition or refurbishment of an enlarged processing facility at one of their projects, Cal East, and sort of bringing that forward by 12 months. And they want to...
They can only do that because MMS ripped the dirt out so quick.
At Murray, yeah, that's right.
Exactly.
And so they want to increase... They initially designed that at 0.8 million tonnes per annum. They want to increase that to, over 1.2. So as part of this raise, they've set aside $35 million as they've labelled it as the equity contribution of a Cal East plant installation or acquisition. It sounds like they currently own some major mill components, so we'll revisit that in a bit. And they're sort of currently envisaging mining operations with this sort of acceleration in mind, commencing mid-2026. There's another $20 million that they've attributed to the remaining Paulson's restart costs. They want to drill $10 million across sort of all their operations. And then there's around $33 million left in sort of working capital and balance sheet sort of restructuring. So it's sort of, by doing this raise, it sort of removes the need for their, previously planned secured debt with Nabari and the associated warrants with that. And it also enables them to repay their existing convertible notes with Sunday, which are worth just shy of $10 million of principal and interest. And they're apparently permitted to, make an early repayment without penalty.
I think this is like the branding in the gold sector at the moment, debt-free and unhedged.
Oh, no, they're the two big words, right?
Like the balance sheet, not much fragility in it. Like I think that's what
balance sheet strength.
That's what the money's looking for at the moment. No,
very much so. And so by the time you wash all of that, through, what does this pro forma cash kind of look like now? So they had $18 million at 30 September. If you add the gross proceeds of the cap raise of, say, $80 million, take away the $10 million that they're intending to repay to Sunday for those convertible notes, that leaves around $88 million in cash in the bank. This is obviously before capital raising costs and things like that, with no more debt, no more convertible notes. And going forward, like, what are they actually planning to do? They're still mining and producing at Murray and Boundary at Cal East. They're expecting first gold at Paulson's later this year. They want to start doing more drilling at Cal East to help, sort of backfill this, expanded processing capacity they're looking at sort of having, and also drilling and studies at one of the other projects, Coyote, to accelerate its restart by another 1 or 2 years.
That's the Tanami one.
Yeah.
That's the one. And so, end of next year, they want to be producing around 100,000 ounces per annum. So I guess
between the two,
between Paulson's and
Cal East. So.
That's right.
Gotcha.
Yeah,
it's funny. I remember we talked about Black Cat in the early Money and Mine days. Such a different gold price, but like talking about very. I know it's a small part of the mine plan, but the riskiness of the Gabbro vein areas and everything, but it's like when it's freaking you're unhedged and selling it over $4,000 an ounce. Holy shit, there's a lot of wiggle room now, and like stringers in dry. Like people talk about the reserves and all that sort of stuff. Like places like Paulson's, there's potential stringers everywhere. You could go and chuck a jumbo drive in. Like it's so forgiving, and it's like you can't put all that shit in reserves. You mine it sort of reactively and as you go, and it's just the landscape has changed so much since the start of this year for places like this with a freaking mill and a existing brownfields operation. So, and that's why you see it all in the friggin' share prices of these companies. Yeah, it's it's go gold.
Yeah, and even just getting rid of the debt from the balance sheet. Like I always feel really just nervous when you've got a marginal producer that has sort of like even a modest debt quantum as they're going through what is a tricky phase of ramping up, and a lot of unexpected things come your way. Having no debt, like I think in the long run, is the right risk adjusted thing to do, because you don't have to then pay out your debt by raising new equity if you encounter one of those hiccups. You've got the equity only kind of balance sheet, which makes me more comfortable.
And you're so protected against if the gold price goes down.
You'll still be operating at a loss if the gold price went down, and then
But maybe you don't have to pay debt as
exactly,
well.
Exactly. You don't cop it both ways. Yeah.
So just on those points, really about that sort of switch from having a debt component and I'll wrap the convertible notes in there too. A more equity funded strategy. I mean, so they actually entered into a credit approved term sheet with Nabari on the 5th of August for US $20.5 million, a 3-year sort of senior secured debt facility, had an interest rate essentially of a base plus a 8.75% margin and a bunch of warrants as well. That facility was actually like all the docs and everything like that was due to close this month. But, like we said, what's changed since then? Higher share price. I mean, look at the Spark chart, early August, Black Cap was trading in the early 30s, and since then has, practically doubled in a few months. It's currently trading in the mid 50s. Aussie gold prices gone up 10% in that time as well. And so they've obviously gone through some sort of assessment process and gone, okay, what's the cost of equity, dilution versus debt, and the much, higher share price, gold price, all the rest of it. They've obviously gone, well, no, let's take advantage of the current environment and equity fund.
Well, it's good to, even after a couple of months later, I'm sure there's a bit of work that goes into that, but acknowledging right, even though we've put all in the work, share price is good, let's just fucking clear it now. So that's a good move.
And so as a reminder for the money miners, so the Cal East feasibility study update, which Black Cap released early this year, shows around a 50,000 ounce per annum production profile over an initial mine life of around 7 years at all-in sustaining of around $1,700 an ounce for pre-production capital of $98 million. There's also an additional $123 million of future development capital. I'm not sure at what point in the mine life this occurs, or if it's sort of spread out over the course of it.
Yeah.
But either way, Cal East will still need some more funding to get completely up and away. But today's raise, the $35 million that they've set aside for the mill side of things is certainly a good start. Future cash flow from Paulson's and the current operations at Murray could help contribute to at least some of that balance of the remaining, funding piece too. I did actually notice in the Cal East study update, they noted that all the FIFO personnel are likely to be accommodated in an existing mining camp located at Mount Munga Pastoral Station, 15 km south of one of their deposits, Majestic.
You don't want to drive that far each day, do you, GC?
No, I mean, do you think they've considered just getting a grounded camp right there on site?
They should now, after you've said that.
Yeah. So, I mean, look, we've shown everyone a lot what these grounded camps look like from the outside, but check out the inside. Look at this. Double beds, blackout blinds, better acoustics and security, larger showers and TVs. I mean, how good is this? You might even catch Paul Natoli and the team there serving you fresh Sicilian pasta and cannolis on arrival.
Mate, you see the soap at the front of the bed there. There's going to be some bloody custard cannolis sitting there as well.
Just right there for you.
The best thing about a double bed on a mine site?
What's that?
You can sleep a different side each night.
That's the best.
Best thing
that is the best thing.
It's funny, you say they should build a new one 15 k's away, mate. Granted, they also upgrade existing facilities so that they're more luxurious.
Mate, they could upgrade the bloody Mount Munga Pastoral Station. Yeah. So there's 2 options available.
Got all the options you need. Black
to
Cat,
a Sicilian quality.
Yeah.
with the Sicilian service, the cannolis.
7-star mining camps.
Love it.
With cannolis.
This is all very interesting, Ali. The thing I think about though is there's a little bit of equity side posted for processing like solution at Cal East, which throws into the question, well, where are they going to process the colours? Because at the moment, MMS are doing, they're sending it, I think, to Paddington. I hear Paddington is kind of chock-a-block at the moment with a bunch of different toll trees. In fact, all of the kind of, milling infrastructure that is, you're able to toll stuff to in around the goldfields is like chock-a-block at the moment. So
it costs more to do it.
Yeah.
Yeah.
And
even Norton Goldfields are making money out of it. On a processing front.
Even like Piggy Bartlett's effort, like I'm pretty sure that mill is chock-a-block with Northern Star like demand for the next like 12 months too, which is
so what's that? That's the Greenstone one, is that right? I think
Greenfields,
Greenfields or whatever it is. I think
so.
Greenstone's another. Yeah. It's like because as I say, talking about acquisition of a mill, it is interesting. Because another one I've heard is, if you say that one's chock-a-block, I've heard Lakewood is being underfed.
Okay.
For the beta hunt.
Yeah.
So it sounds like at the moment, like a lot of that could go to Higginsville. So I'm not sure if Westgold would ever flog off Lakewood because I think Higginsville is the better mill than Lakewood.
Lakewood's only got 7 years of tail, like they've recently done one more tails lift and 7 years left that of capacity there, and that's it. There's no more. You can't do another lift after that. That is the maximum. You can only get 7 years worth out of that.
Oh, right.
Facility.
So why is that a permitting thing?
Yeah. So if you wanted to
is
sell
there any opportunity to?
No, that's it. That's done. So if you wanted to get value for that infrastructure and you did want to sell it, I think you do it while there's still like capacity in that.
Yeah. So that'd be because if. For the Westgold one that's if they did just send everything to Higginsville. The other thought, if my little astral prediction comes through, like they'd probably Lakewood's not big enough to probably take. You wouldn't be trucking open pit dirt up there anyway. So it's like it might become redundant if they bought that and had a 2 million tonne base feed coming from pits there. Probably build an enlarged facility there and take beta hunt there. That's one option. The other one, there's plenty of mills in the friggin' district, but it's size. If they want to go to 1.2 to 1.5 million tonne, you need the size. Like I think the Northern Star's old Jubilee processing plant.
That's on care and maintenance since
1.2 million tonne, but I think that's probably 50 mil refurb at least, or circa plucking numbers out there.
That's interesting because they said they wanted to go up to 1.2, didn't they?
1.2 to 1.5.
At least 1.2.
That fits the description.
Yeah, well, but I guess it's on the other side. Interesting one's KB, Kanana Bell.
Oh, yep.
For Northern Star. So, because it's 2 million tonne, still pumping there's still got, it looks full based on the last quarterly, but you would assume when KCGM expansion is done, bloody Kanana Bell, South Cal operations, everything will go to KCGM. I would assume. I'd assume they'd just turn everything off and just chuck everything to feed 27 million tonne through KCGM. So,
do you reckon?
Will KB come onto the table?
Don't know. Have they talked about that, Matty? Have they said it like that?
Nah, ChatGPT said there was comments, but I couldn't find any.
KB has such.
But they have talked about like sending everything. I swear they've talked about centralising everything just straight into KCGM. Like, fuck, if you got 27 million tonne, why wouldn't you? I know I remember him saying South Cal stuff would probably go there. I don't know if that was in an announcement or at a pub.
And that's 27 by 2029, is that right? That's
I think it's
going off memory from a good while ago.
Yeah, I think it gets to 24 or 25 before that, and then it is obviously staged. Yeah. But I don't know if that'd ever come onto the table, but it's probably not short term enough. I wouldn't imagine. But it'd be it's being looked at.
Option.
I reckon because you get all these efficiencies from sending like deposits here and there, depending on how far you're trucking it and all that sort of stuff would come in. You got to truck it a bit further from like KB to Fimiston.
Yeah, but
depending on where you get it from,
Manning as well. Like bigger mill, less like you got to have a whole extra bloody whole level of management. Operating that processing plant where you can like centralise it in one. I think there'd be a lot. I think every day of the week you'd save cash trucking it to a big massive mill with less personnel working there.
I think KB's
per tonne.
KB the last roaster in WA that's still operating too.
That the Gidgee the Gidgee one?
It's not Gidgee. Yeah, it's Canana Bell's got a roaster.
Oh, yeah. I know they were, but I think as part of this expansion, I remember a comment a quarter or two ago, they was trying to get it to the stage sooner where all the roasting, all the use of the refractory was going to be done at the KCGM and not at the, I think, Gidgee one or something. I don't know. I should research more.
But yeah, my point is just that roaster in and of itself is a pretty interesting has a fair bit of value because that is a processing solution for a fair few ore bodies in and around the region which don't have a processing solution. Think of Aphrodite, which is in Genesis's portfolio, beautiful ore body underneath a road, but needs a roaster.
Yeah. What was the other one? No, that's the main one. What's the other? Zoroastrian. That's the non-refractory one.
Yeah.
And then that's, bringing it back to, sort of Black Cat and Calais and trying to sort of address this in the next, year or two, whether, some of those options might be too long dated to suit them and, will they have to perhaps construct something and then, what's the timing and the permitting and, everything, associated with going down that path as well. So just something else to have in the back of the mind. But then, and then separately, they've got some options expiring sort of within the next year, which are pretty in the money at the moment. So they might have some other cash potentially coming in the door just to help towards that, that funding piece as well. So
there's about $6 million.
Yeah, sort of that expiring, in the next year, and there's sort of a bunch of other unlisted ones at various exercise prices expiring the next few years as well. But yeah, no, great to see, mines getting built and, accelerated and all of that. So
I suppose
keen to watch the journey.
They're saying it's been accelerated till the bloody government gets involved.
Yeah, we shall say.
Yes, right. Next up, Vault. First time we've flashed up the Vault logo, I think.
Yeah, look at that. It looks slick, doesn't it? And I'm a ding on Vault as well.
They're a ding of a lot of cash. So Vault, the old Red 5 Silver Lake thingamajig, you'd say. So sold a bit over 100,000 ounces for the quarter, 102.5, at an average sale price of $31.62. We'll get into their hedging a bit later. So the open pits are sort of ramping up at Mount Munger. It looks like the underground for side of things at Daisy and that's starting to drop off. But they said they got like 6 years of baseload mill feed coming out of the pits there. Deflector had a ripper of a bloody thing, bit over 30,000 ounces of gold produced at a pretty 1820 all-in sustainable. Remember, they got the copper that comes off that as well. So Leonora, so King of the Hills, and so that's Leonora refers to King of the Hills and Darlow, so a bit below 50,000 ounces for there. So it looks like they're in a bit of a big pre-stripping mode for King of the Hills. So they're limited, I think they're limited mining fronts. You see the amount of extra waste moved. So like their total BCM moved of the ore and waste was, significantly a good chunk ahead of what had been done in the previous quarter. So it says, I don't think till about second half FY25 they get to sort of access the newer mining areas once a lot of that next stage expansion's done. So, and hence you see the mine grade drop from 0.7 down to 0.54 for King of the Hills. But they're obviously going well with the throughput and everything. God, I lost me bloody thing. Here we go. I'm back. But yeah, operating at a bit over 4.3 million tonne run rate for that mill. So she's all ticking along, talking about expanding it to 6 million tonne per annum.
Wow. That's big.
Yeah, just go big. Just go big. Go to 8. 8's good. 8 million's good. Cash and bullion on hand, 523 million buckaroos. So underlying free cash flow for the quarter of 35 mil. So it actually it increased 70 mil, but they had sold the shares in themselves and all that sort of stuff. So there's a bit of post-merger stuff.
Sale of treasury shares. Yeah.
Yeah. So, but yeah, so the hedge book, which is obviously the legacy stuff that come from, King of the Hills being debt funded. It's one of them ones where it was debt funded, get a heap of hedging, then you had to do a heap of capital raises and it's all been cleared, but you have to keep the hedging, unfortunately.
Well, this is
Wish they
interesting.
wish they're like, you're debt free. We'll get rid of the hedging for you.
Well, they said when they did the deal, like, okay, we've got access to Silver Lake's cash. Opportunity synergies include paying out the closing out the hedge book with our cash or accelerating growth of COTH. And it looks like they've chosen accelerating growth of COTH with the cash instead of closing out the hedge book, but with gold price running. Yeah,
it's like maybe 2 months ago, but you don't know. You close it out now, and the bloody gold price goes down. As I said, you need to get about 5% lift in it just to negate the interest you would have earned on that money in the gold price. So, because they got pretty much 40% of their forecasted production for FY25 hedged, 122,000 ounces at 27.34. Remember, gold price is sitting in over 4,000. FY26, 122,000 ounces again at 28.82 per ounce. So that's about 31% of their production. Beyond FY26, pretty much unhedged. I think they've got 10,000 ounces hedged at 27.97. So it's getting them, which looks like it will line up to so when do they're getting to the high grade areas? FY25, end of FY25. So they'll have it's one of them ones. Do you close it out now, or they just ride the wave and get to FY26 when she will start raining a bit? End of FY26 where she starts raining a bit more. So
it's a bit of a tricky one because you're trying to take a bet on the commodity price, right? Like, do you believe it's going to continue going as high as it has, in the last year, or if you, because, you could take it out, like you say, Maddie, and then if the gold price doesn't move or it goes lower, well then, what was the sort of point thing? And, perhaps is there a better use of capital to, they're obviously, looking at expanding COTH further. They're due to put out their capital sort of management, program or sort of plan imminently, as far as, maybe that'll be, returns to shareholders, like a buyback or a dividend, or, things like that as well. So they've got, I guess the fortunate position is they've got, a fair bit of cash and at present no debt.
Yeah.
To sort of service and work through those hedges.
Yeah. I think the best way to minimise the amount of the percentage of production that is hedged, get more ounces. Merge with Genesis already. Then I don't have to keep frigging talking about it. It's got to happen sooner rather than later. Far out. That'll just then it'll be like 20% of their production. Piece of piss.
There you go.
God.
Diamonds, JD.
Let's talk a bit about diamonds. I'm not sure.
Mate, you're the biggest diamond in WA mining commentary that is sub 30, JD. Tell you that for free.
Make me blush, mate. Have we spoken about diamonds? I was trying to think before. I'm not sure if we actually have in any sort of great detail.
Besides De Beers with Anglo.
Yeah.
Really?
Yeah. That was the one that briefly came to mind. So Burgundy, bar Rio, is the only way you can get, it's the only way you can get direct exposure on the ASX, and it's a bit of a new vehicle. So I'll sort of preface what I'm going to say here that I've got pretty little knowledge of the diamond space. I'm keen to learn more, keen to get an expert in the field on. But I thought the quarterly that came out today was worth a peek for a few reasons. So first and foremost, Burgundy's got some, a decent management team with some big names sort of in their ranks. So first up, you've got Michael O'Keefe. He's of Riversdale and Champion Iron fame, sort of made a lot of money for himself and shareholders. Previous to that, he was the boss of Glencore Australia. He's the non-exec chair at the company, owns about 5% of the stock. These guys bought the Ekati mine 15 months ago, and on 23 numbers, it's the sixth biggest diamond mine globally, and it's the only one that kind of sits in the hands of a small cap. BDM is capped at 150 million. Net debt of, that's Aussie dollars here, net debt of Aussie 34, but they've got diamond inventories. These are carried at cost at Aussie $108 million. So the balance sheet has changed quite a bit since these guys took control of the company. All the while, the stock has actually halved. So the chart isn't pretty, and that's sort of in the face of a diamond industry that's struggling.
Piqued my interest, JD.
Yeah. And, I was thinking the exact same. It's a hated space. There's complexities to it, but it's enough to sort of get interested. So diving into the actual quarterly result today, the outcome is kind of so-so. They're doing a lot of mine life extension work. A lot of this work did disrupt the actual mining. They also transitioned from the Sable open pit to the Point Lake open pit. Recoveries were a bit lower than expected. That was sort of on the back of the grades process being a bit lower as well. But on the cash front, I'll chuck up the waterfall chart so you guys can have a bit of a look now. They did US $23 million in operational cash flow before working capital comes into account, whilst the revenue per carat dropped 20%. So you've got the commodity price not going in your favor. You're at the sort of lows, if you like, in a commodity price, whilst you're still making money on an operational front. They did pay back a con note. So like I said, cleaning up the cap structure to the tune of US $23 million. They also spent US $36 million on CapEx, 2/3 of that going towards waste stripping. So overall EBITDA, it was down a couple million to US $22 million. And yeah, just pull up the waterfall chart. There's a lot of numbers are sort of slung out just then, but bearing in mind that the commodity hasn't done so well, it doesn't look all that kind of bad. And we're expecting a strong finish to the year because these guys actually give revenue and EBITDA guidance. Now, that guidance was revised lower, but given where we are and where they said they'll still get to, the numbers should finish quite strongly. So all up, cash flow side of things, very interesting from my perspective to see operationally a bit of cash coming in the door while things have been pretty beaten up. And this next chart I'll show here is quite an interesting one. For those listening in and not looking at the chart, it breaks out over, I think, the last sort of 5 quarters or so, a few different balance sheet items, and you can just sort of get a feel for the trend. So firstly, it's a good sign to see that the company's focused on what's kind of important, and it's good to see how they're kind of working towards them. So I'll give a couple examples. One of them is diamond inventory. These guys have had a lot of money tied up in inventory, and they're aiming to reduce that. Another pretty straightforward one is reducing your debt obligations. So again, working well to clean up these sorts of things. They also said that in the quarter that we're now in, they're going to put aside US $22 million for an environmental trust. This is a pretty common thing we've kind of seen with the Canadian miners. It's your cash, but it's not your cash. You've got to have it tied up in a trust, and there's some tax benefits to that, the company said as well. So
really interesting, mate. When I think of the whole diamond industry, it's like the price has been under pressure because lab-grown diamonds come in way lower on the cost curve, and people have been willing to accept them as it's literally the same thing. It's just created with a different way.
It's not the same.
it's like bushweed and hydro. That's different.
It's not the same.
What would you have done if Paul proposed with a lab grown rock?
Oh, jeez.
Take it back.
Take it back. No.
Yeah.
Oh, no. I don't know. There's something romantic about a real diamond.
That's interesting. See, I've had the chat.
Ask the engaged woman.
I've had the chat with all my mates. Granted, all my mates are knuckleheads, but lab grown rocks. Like everyone's a lab grown rock. I've had the chat with Broads. She's happy with a lab grown rock. Like,
I mean, chemically, it's basically the same thing. It's just formed. In a lab.
Yeah.
Go to the last picture I've got here, guys, and we'll flash it up now for those listening. And you can see, obviously, the company addresses this head on. And obviously, the company talks about growing demand for mined diamonds as opposed to lab-grown diamonds. And you can sort of see they talk about a bifurcation in the diamond market. And obviously, they have put their own numbers to it. It's from the sort of analysts that they kind of use. But it's interesting to see the size of the mined diamond market relative to the diamonds that are grown in labs. So again, for those listening, I'll say the 2023 numbers is $43 billion of demand for those that are mined versus a lab-grown market of $7 billion. So mined is still bigger, and it ties in with what you're saying, Trav. We're at that kind of inflection point now, which makes it a very interesting debate because, that the debate wasn't a really fair one to have 10 years ago, 5 years ago, because the costs were so different. So that outweighed anyone's sort of feelings to the emissions or anything else that's sort of tied up in the purchase of, what's been a pretty big purchase for a lot of people. So that is one of the big knocks on the company. And there's another couple that we should kind of address as well. Short mine life. That, whacks you in the face when you kind of look at it. And again, the company's doing heaps to kind of address that. Lots of drilling. Like I said, it sort of disrupted their quarter just gone. But that's also on the flip side, a big catalyst. Misery, the kimberlite pipe at Misery is the big one, the high grade one. If they can extend that beyond 2026, that's a bit of a catalyst. And they've got a bunch of other deposits that you'll have seen in the map before. If they can extend the mine life beyond where it kind of sits right now, trailing off in 2029, then that's a sort of big boon for the company. And the other kind of knock is single asset miner in a relatively remote part of the world does come with its fair share of risk. But on the positive side of things, like I said, management team that looks the goods on paper, cap structure that's being cleaned up, an asset that's being optimized through varying sort of degrees. So they're a bunch of the positive boxes that these guys are checking. And yeah, I mean, that's all in a sort of hour of digging into the company. I think there's more than enough for us to kind of get interested and speak with some experts in the space and learn a bit more about it.
And I was under the, I think I've made the comment before, I think the diamond market's fucked, but I think heck, Ali's view there in itself is evidence that there is demand for plenty of people have different consumer preferences, right? And there's a subset of consumers that are going to want fine diamonds and they're willing to pay a lot more for them as a result because they're more sexy, more prestigious, more romantic. But
mate, you could buy shares in friggin' family lawyers because bloody those homegrown diamonds might result in a shitload of divorces in the future.
Counter-cyclical.
Yeah, mate, that's bloody where the coin's going to come in.
Yeah, I mean, I think the other part of the debate with De Beers back when we spoke about them is they're kind of a luxury retailer as well. So it goes, in De Beers' case, that is, it's not the exact same case for Burgundy, but there's definitely nuances to it.
We need to get a diamond expert on.
We do. I've reached out to one, so it's going to happen soon.
Love it. Beautiful.
Oh, very good. Well, we better mention all our natural diamond partners. Not homegrown. We only have natural diamond partners from the earth. Mineral Mining Services.
Grounded at the top of the show and CRE at the top of the show as well.
Oh God, I feel like getting engaged now talking about all these people.
CrossBoundary Energy, Sandvik Ground Support, Greenlands Equipment, K-Drill, MMTS, Australian Earthworks and Haulage, and get a spark jar up your hoodaroo.
Get a spark jar. That's good.
The information contained in this episode of Money of Mine is of general nature only and does not take into account the objectives, financial situation or needs of any particular person. Before making any investment decision, you should consult with your financial advisor and consider how appropriate the advice is to your objectives, financial situation and needs.